Good morning, everybody. Welcome to this webinar on the UK Government Trade Credit Insurance Scheme and how it can support your business. My name is Matt Strong, and I lead the UK Credit Specialties team here within Marsh JLT Specialty. I'm very pleased to be joined by two of my colleagues, Ian Watts, who leads our UK Trade Credit Practice, and Steve Howes, who leads our major client practice within the trade credit team. We can move on to the next couple of slides then. In terms of when we look at the agenda today, we're intending to cover quite a lot of ground in the next 45 minutes or so. The reason being is we need to firstly set the context around the impact of COVID-19 and the UK government response. And then what does that mean in terms of the importance around the credit sales, and what role does the credit insurance market play in supporting the UK economy, and particularly the recovery as we come through the other side of COVID. We will then explore the details of the UK government scheme, which has been announced, noting that it still needs ratification from the EU. So please be aware that there still is a degree of fluidity and complexity, but also certain elements where we're still awaiting clarity on. But what we intend to do over the next 45 minutes is to give you as much insight as possible within this. And then lastly, how you can compare in terms of your business, and then how Marsh JLT can support you in that regard. So as we go through, we do intend to try and address as many of your questions as possible. There is a Q&A button at the bottom of your screens. Please do feel free to submit questions as we go through, and we will seek to address them. If we cannot do so because of the time availability, we will come back to you with answers after the call. So what has been the impact of COVID-19? We've seen a significant impact on all of our day-to-day lives and also the economies around the world, whether it be the way we operate as a business, the way we interact socially, and the way we engage with each other. It's been changed. And certain aspects probably changed in the longer term as well, as certain new working practices come through. What is clear is from the first reporting at the end of December last year, through to then the announcement of the pandemic by the World Health Organization, we have seen impact across the globe. Travel restrictions and lockdowns taking place, supply chains being fractured and disrupted, workforces having to adjust, businesses pivoting in terms of how they pitch and target their businesses. But certainly we've seen considerable market volatility in global recession. Here in the UK, the OECD has predicted 11.5% drop in GDP. So there has been a significant impact, and the UK is very much at the far end of that spectrum as well. So this data here on the next slide is looking at the impact from Moody's predictions. And as you'll see on the far right-hand side of the slide, even the most optimistic of levels, when you look at the global default rates, anywhere between 11.3 to 16.3% is being predicted. If you compare that back to the financial crisis in 2008, 2009 and 10, that will be similar to and probably greater than what we saw in that crisis. And in a way, that crisis is slightly misnamed because it came out of a real estate mortgage issue, which then accelerated into a wider financial impact. Here, with this pandemic, we are facing a truly global financial crisis with every sector being impacted and every country also being affected in this regard. So what is clear again is that we are all going to be operating in a very challenging environment. We already are, and we will continue to do so. The question is how will that economic bounce back, both globally, look, whether it be an L, a V or a U. Of course, the hope is that we will be looking at a V, but there are still some discussions going on, and it is too early to tell, although some of the early signals are in the last few days that there are already seeing some green shoots within the economy within the UK. A lot of that is also due to how the UK response has been rolled out. And you can see that significant liquidity has been pushed through and pushed out by the government to try and help support businesses and the like. Now, I won't comment directly on a lot of these things, but what is interesting is the breadth and the level we're looking at. Now, what we've seen is $55 billion of borrowing in May alone. And the UK borrowing is now greater than we've ever seen in terms of against the current GDP. So the rates we're seeing is at 100.9% of the annual GDP. So that's significant. Just one point to note, and it may not everyone be aware, is when we look at that last point, most recently, the government of England, so the Bank of England has relaxed the counter-cyclical capital buffer to 0%. A lot of people may not be aware of that. That is effectively a rainy day equity buffer the banks have to retain. And by reducing that down to zero, that is releasing back in about approximately just under $200 billion of liquidity back into the system. So a lot of liquidity is being pushed into the system, but how does that now waterfall down? And certainly when you look at the trade credit market, that is similar with the government scheme as well, but it is part of a wider context and rescue packages being rolled out. So let's get into more focus now onto the trade credit market and what's happening within that part of the insurance market. Ian?
Thanks, Matt. And very, very pleased to have so many of you on board today. So why, in the context of all that support from the UK government and the Bank of England, does 10 billion mean so much to the UK economy? Just a bit of context again around that. So UK GDP is around about 2.21 trillion. That's the total production within the UK. The credit insurance market is insuring around about 350 billion of credit sales. That's both domestic and export sales. It's not just UK business. So that level of penetration within the overall UK GDP is very, very significant. For any organisation, the majority of their assets are held in trade receivables. Generally, it's around about 40% of UK company assets are held on trade receivables. And that unsecured credit facility that all organisations work with creates a very, very significant multiplier effect to the overall money supply. Something like 1.5% of overall global GDP is generated through short-term trade credit sales. And we found some research. This research, unfortunately, is a bit old, but the entirety of trade credit extended around the world exceeded that of global bank lending. So some very important significances of trade credit. And we know, and you know, that trade credit is the lifeblood of British businesses. That's why the ABI, the credit insurers, sort of got together through the back end of March and April to try and put some context around whether the government should step in and provide some support for trade credit. We can move on to the next slide, Steve. Okay, so we all know that there's been a very significant impact of COVID-19, and I think we've covered off some of these points already. And there are certain sectors that are much more significantly affected by the COVID-19 pandemic than others. We've seen real strife in the aviation, transport, hospitality sectors. And as a consequence of that, the insurers, whose responsibility it is to manage risk as much as sort of transfer risk, is to make decisions that have reduced their exposure in those sectors. So the policy impact there is that we're seeing some numbers of increased reductions across the portfolios that our clients possess. So all of this fed into the insurers approaching through the ABI, the UK state, to see what support could be generated for trade credit insurers, because the importance of it to the UK economy is huge. Without that support, we saw in 2008, 2009, during the last financial crash, that the insurers did take pretty much a very large knife to their portfolios. And whilst they've not done that this year to such an extent, it was still a concern that was overriding overall. Steve, we'll move on to the next slide. The one before that, that's fine. Okay, so in response to that, it's not just the UK. We're seeing governments around the world taking actions to support the trade credit insurance market. I don't know if many of you read in the press overnight that the US fashion industry had approached Donald Trump to try and get similar support for their business lines as has been agreed throughout the rest of Europe. As Matt pointed out earlier on in the session, the UK scheme is still subject to EU approval. In our conversations with insurers over the last couple of days, when this first became apparent, it was clear that the scheme, as far as it affects clients, wouldn't change that much. The back end, as it affects insurers, may change slightly. So we have high expectations that within a couple of weeks, it will come through, it will be approved and ratified by EU, and it will be launched to the wider UK market, as it has been already in Germany, in the Netherlands, and in Belgium and Denmark. The French scheme differs slightly from the other European schemes in that it's similar to the CAP scheme that the UK operated back in 2008, 2009. Unfortunately, that wasn't that successful in the UK. So it was important that the new scheme that was developed for the COVID-19 pandemic crisis was different and approached and dealt with the issues that weren't dealt with at that time. So our expectations are that within 2 weeks, the scheme will be fully and formally launched across the UK. So some details of the scheme right now are that the scheme runs until December 2020. So it picks up losses that attach after April 1, and there is a review point which comes at the end of September. The scheme is managed by a special delivery partner. That partner is yet to be named, and we expect that to be announced shortly. So the expectation is that at the point in September when it's being reviewed, there is some evaluation of the impact post January 1 when the state comes off being the reinsurer for this particular period of time. Okay, what it covers UK clients where they're shipping and providing goods and services from the UK, where UK insurance premium tax will be paid under the policy. If they're exporting and an insurance premium tax is not due to be paid, they would also be covered. There are some conflicts within the overall EU approach to this, in that there are gaps within the system. So we would be working with you where you might have an insured located overseas, because they may not form part of the UK scheme. They may form part of another European Union scheme, but they certainly wouldn't form part of the UK scheme. Just to reiterate, the UK scheme covers transactions within the UK marketplace where UK IPT is paid, or where there are exports directly from the UK. If you are a joint insured under a European policy, it's possible you could be covered, but again, we would need to consult with you and the insurer as to whether that was formally included. The purpose of the scheme absolutely is to try and reinstate cover that was withdrawn specifically as a result of the COVID-19 pandemic. We've seen, as over the last couple of days, insurers corresponding with clients where there is an intention to possibly withdraw cover. The cover will be reinstated under the government scheme because it was withdrawn directly as a result of the COVID-19 pandemic. So our expectation is that where cover has been withdrawn and there is a need to initiate new cover to cover transactions as business recommences, the cover will be reinstated by the insurers. It will not pick up liability, will not undertake capturing the risk of those organizations where the risk is, as at January through to the end of March, was already significantly deteriorated. Its purpose is to reignite the economy post the pandemic. As business starts to recover, as clubs, as pubs, as travel starts to reopen, that's its purpose, and that's what it's designed to do. Now, just a bit of detail around the expectations of the losses that may be incurred under the programme. The government has set aside a 10 billion guarantee for the reinsurers. Our assessment of the potential losses across the UK economy probably don't run to much more than 1 to 2 billion in a worst case scenario. At that point, the insurers will only pick up 10% of the liability for any losses. The objective is that 90% of premium is ceded to state in return for them taking up to 90% of the losses. In excess of 3 billion of losses across the UK, then the state will pick up 100% of the losses. These are the aspects that are currently being ratified by the EU in consultation with BEES. The scheme is effective from April 1. It will not pick up liability for losses incurred by insurers prior to that period. It's a losses attaching program. If the insurer chooses to or is able to reinstate cover for you, then you have the possibility of requesting that they retrospectively reinstate the cover back to April 1. That's on a case-by-case basis. There are differences of opinion between the insurers as to what they would be doing, but generally we understand that if you need cover reinstated from April 1, then it's possible that that can be covered. Certainly, the expectation is going forward that there would need to be some sort of validation of the cover that's required. So where cover would be written to need as opposed to what the original limits were. So there may need to be some evidence provided of the limits you request going forwards. That's part of the background to the scheme. So I think that kind of wraps up the main parts of it. Effectively, just to recap on that, it runs until December 31st, 2020. There's a review period at the end of September just to evaluate how it's going. The scheme is subject to evaluation by a special delivery partner who will be assessing and monitoring the performance of the insurers. The insurers cede the majority of the premium back to state, and the state picks up the majority of the losses. That's very similar to the other schemes across the European market. There's a bit of detail that we need to understand. That specifically relates to situations where you might have a joint insured in another country, or you may be a joint insured under a policy issued by one of the insurers in another EU state. But we're very confident that those situations can be managed quite comfortably in consultation with ourselves and with the insurers. If I move on to the next slide, I'll introduce you to Mr. Steve Howes.
Good morning, everybody, and thanks from me also for attending this. My name's Steve Howes. I'm head of major accounts here in Marsh Trade Credit. Also, due to a technical emergency, I've recently assumed responsibility to drive this slide deck, which I've never done before and don't have a license to do, so please bear with me while I multitask here. So for the next 10 minutes or so, I'm just going to talk about what steps can be taken to manage credit risk in this current crisis, but also how credit insurance has helped some of our customers in different areas in recent times. So what steps can be taken to alleviate the credit crisis? One area that businesses are currently considering is to review the bad debt provision. Are you providing for the latest level of bad debts likely to be incurred over the next 2 years? Any recovery from this crisis will run at least into next year, which will coincide with potentially a hard Brexit. In current circumstances, you may need to reserve much more than before to cope with increased insolvencies and delinquent debtors. Transferring the risk to a credit insurer means you can preserve profitability by minimising your bad debt reserve. We also have been recommending that our clients assess the vulnerability of their supply chain. Work with suppliers to make sure they're happy to supply you to pre-COVID levels. How has this crisis affected them? Share your plans and management financials with your key suppliers. If you're coming under increased pressure to stay within reduced insured credit limits from your suppliers, we may be able to help. We can use our relationships with the market to supply them with the current information, give them confidence to write the limits your suppliers need. Make sure your key customers also are in good shape to resume previous levels of trade credit sales. How has this crisis affected them? Has it caused a short-term issue, or was this lockdown the final nail in the coffin of a failing business? We also recommend assessing exposures. Do you have a key customer that accounts for a significant proportion of your turnover? Have you considered the impact of the failure of this customer? What risk mitigation is in place if this were to happen? And how much new turnover would you need to do to replace the profit hole caused by their failure? If you're looking for new customers or increasing exposure with existing customers, how much do you know about their current circumstances? They may already be paying other suppliers late, and credit insurers use their proprietary information to warn you away from customers already in obvious financial difficulty. Look at the credit control procedures that you have in place. Consider how well you know your buyers and customers, and whether you're disciplined in chasing customers for payment before, on, and after due date. Customers often pay insured suppliers as a priority due to the adverse effect late payment can have on their credit lines. Are you comfortable with your days sales outstanding, and how's this affecting your cash flow? Can you tighten your payment terms to help? We also recommend reviewing access to finance at this point. It's a good time to create liquidity within the business. You may already have drawn down on your revolving credit facility. This has certainly been a trend in recent times, or taken advantage of the package of government support that Matt outlined earlier on. Invoice financing can also be a good way to generate cash, linked directly to levels of sales. And credit insurance can be assigned to financiers to give them confidence to lend more as and when it's needed. You should look at your credit management procedures. Do you have consistent credit management procedures that create a uniform approach to granting, managing credit and collections across the business? Do you have escalation procedures to agree exceptional credit limits? And do you use reliable, efficient third-party collection agents? Again, insurers can offer this service and have a vested interest in collecting debt. Look at your systems for cash collection. So we've had a look at a few areas here. All of these areas are important and can be enhanced with effective credit insurance cover, whether or not it's backed by the government. We've got a few examples here of different types and sizes of our clients who've been helped by credit insurance in different ways and different times. So in terms of transferring the risk and avoiding the impact of bad debt, change the slide. We had an SME client of ours who had £1.5 million cover on British Steel. This represented more than half their turnover. When British Steel went under, it was a very precarious time for them, and the claim was far from straightforward. Our specialist trade credit claims team worked hard to identify and iron out issues with the claim, and in close communication with the client's bank, secured a large interim payment prior to the full settlement of 1.35 million. This settlement enabled the business to trade on, which may not otherwise have been possible, and maintain the goodwill of the bank throughout the process. In terms of credit management and corporate governance, we had a client, the Japanese head office of a multinational office supplies company was keen to harmonise credit management procedures across Europe and ensure consistency of coverage across all countries. We worked with them to put a pan-European policy in place and provide a local service from both insurer and Marsh trade credit teams. The economies of scale they achieved meant that they covered twice the markets and insurable turnover for the same cost. And cover was improved on previous individual policies in place. We also worked with them to create a European Credit Procedures Manual, which means they have much closer control and visibility of their insured and uninsured exposures. In the realms of finance, a recent client had a large exposure that was not fully covered by their financing agreement due to the rules that they had in place on concentration of risk. We investigated the market for them and found an insurer willing to write the limit in full. The new policy was then assigned to the financier, who then had the confidence to advance up to the full insured limit, improving client cash flow. When we look at growth, growth is a real key element where clients can use the tool of credit insurance to help them. Our client in this example is looking to grow by exploring overseas markets and was successful in finding strong appetite for their products overseas. Due to lack of available up-to-date financial information on their prospective customers, they were reluctant to extend general credit terms or grant limits. So they were selling on cash against documents or letter of credit terms. This was making them uncompetitive against local suppliers and other competitors in the UK. So they took out credit insurance to give them confidence to sell competitively on open credit terms. They later added in their larger UK customers at little extra cost, protecting them against a large unexpected domestic bad debt, as well as securing export growth. When we talk about lubricating the supply chain, an example of this was a client we have in the tool hire business who'd been put on stop by a major manufacturer due to the removal of an insured credit limit. The supplier's credit procedures prevented them from even offering pro forma or cash terms to our client. And the insurer removed the credit limit due to a misunderstanding. In this case, we used our relationships at a high level with risk underwriters to get the limit reinstated, which meant our client could get their fleet of tools repaired and maximise revenue from increased hires. So a real tangible benefit there. So what next? One of the questions we were asked prior to this webinar, very general question, is now a good time to take out credit insurance for the first time? In normal circumstances, based on our experience of previous recessions, we'd be cautious to say yes. As Ian explained, insurers will protect their balance sheets by managing their risk coverage when they see a recession and increased insolvencies on the horizon. They have their own shareholders to consider. In 2008-9, the industry was slow to organise and define the scale of the potential problem. And the government was slow to react to a problem they didn't fully understand. When they introduced the scheme, it wasn't really fit for purpose. With all the previous provisos and conditions that we've expressed previously in the presentation, it looks this time like everyone has got their act together. The government aim is to support credit lines to ensure businesses do not fail due to suppliers' fear of uninsured bad debt. If the scheme develops as we hope, the consequence will be that insurers will take more risk due to the reinsurance provided by the Treasury, and the market will be prevented from hardening too much in terms of pricing, which is another potential consequence of a crisis. HMG have been explicit that this type of protection should not only be available to a closed shop of currently protected businesses. So now is a great time to at least check out what may be available in the market. Insurers, industry bodies and brokers, with Marsh at the forefront, have worked together to plot a course to recovery. The government plans to provide a helpful breeze, and in the right boat, with the right crew, businesses working with us will get a clear head start as we recover from the crisis. As Marsh clients and/or attendees of this webinar, we're happy to get an informal view from the market on your top 3 credit exposures, or to work with insurers on your behalf if you're experiencing pressure from your suppliers on insured credit limits. A feedback form will be sent later today with copies of the slides and a recording of this, with more details on how you can access these services, together with the slides from the Q&A today. Thank you.
Steve, thanks for that summary there. I just wanted to use your experience to share with the audience just your take on how credit insurers are reacting to the crisis this time compared to the previous financial crisis in 2008, 2009. Are you seeing a different approach to this?
I think what we've seen from the very early stages of this was a dialogue. The initial dialogue, as we've said before, was between the insurers and the ABI and other bodies, but they were quickly engaged with the government. I think last time, 2008-9, the engagement was slow. The crisis took everybody by surprise. It was immediate. There was panic. There was a little bit more organisation this time. And the question about insurers, I suppose, is that it varies. Insurers themselves are not sort of analogous. They're not one mass. They are all individual businesses, and they reacted differently. Some took action immediately and have taken no other action. Potentially, if they're in the scheme, we hope that they will review the action that they took, and others planned action which they didn't take while they were negotiating with the government on the scheme. So it's a mixed picture. It's generally been slightly more considered, and I think a more optimistic picture. And what for you, Ian, there actually, you mentioned the insurers earlier on and their engagement with the scheme. Do we have a sort of up-to-date picture as to who's in and who's out, and what the insurer concerns are who haven't committed yet?
So for the audience listening to this, we're not planting questions. We're just getting the questions together that have been asked during the session. So we had a couple of extra ones put in that we thought you might be interested to understand. So absolutely, yeah, we're in consultation with the primary carriers on a very regular basis. So we all know and love Hermes, the traders and CoFAS, and they all came out originally very much in favour of the scheme. And I know they're avidly working with the ABI to tidy up the details with Bs and with the EU regulators. We're pretty sure that a number of others are going to come through, but it's a choice. You don't have to be in, you don't have to be out. It's a choice of the insurer as to whether they participate in the scheme or not. Clearly for Euro Traders, CoFAS and a few of the others, they make up a significant proportion of the insured receivables across the UK. So it's more material, more meaningful to them. But we expect within 2 weeks that it to be fully ratified and up and running. And what we're seeing already is the insurers being very open-minded about this. So as businesses start to open up, they're already considering reinstating some of the cover, irrespective of the scheme not being formally approved, in the expectation that it does get approved relatively quickly. So I'm in a high degree of confidence that the majority of the markets will participate, and it will be all in the interests of the UK economic recovery.
So Ian, just leading on with that, and we've had a number of questions around the sort of the EU approval of the scheme and the timelines and objections being raised. With other foreign government schemes already being approved, that 2-week anticipated approach time, is there any rationale behind that, or why it's taking that length of time? And also, are credit insurers engaged around where objections are being raised? Then are credit insurers pushing back on those?
Yeah, I mean, Matt, it's a good question. Absolutely. I mean, there are a lot of NDAs that attach to this particular scheme, so we're not privy to the detail. Just a bit of context again around some of the European schemes. It might have been better if the EU had got together and come up with a pan-European scheme, which incorporated the UK in some fashion. But each country has come up with its own method of supporting the economic recovery. And we've seen in some of the economies around Europe, particularly Spain and Italy, where they are struggling to come up with a scheme that supports domestic trade, that it's tough and it's potentially very expensive. But in terms of the current situation vis-a-vis the UK scheme, as I've said already, it's probably about 2 weeks away from being fully finalised. The FAQs and the parameters of the scheme to the clients are unlikely to change from what was advertised widely by Euler, Atreides and COFAS. So expectations are very high that it will deliver what we need it to deliver, support for the economic recovery for UK businesses. It's vital in our opinion.
So next question, I'm carrying on from that one. Steve, maybe you can tackle this. Is someone's come in saying, obviously the EU still needs to ratify the scheme, but their experience that they've seen a number of limits actually being reinstated to pre-COVID levels. So is there a disconnect? But we've also had a number of questions of people asking, will their limits be reinstated to pre-COVID levels, or what do they need to do to get to that reinstatement?
Yeah, well, I suppose the condition we would mention up front on that is, as Ian referred to, that the insurers are looking to make sure that they are covering only likely exposure. So if limits have been reduced because of usage, because they don't expect that customers needed them, then they are expecting limits to be reapplied on the basis of likely usage. And the government, that's one of the terms of reference of the government, is that they want to make sure they're not insuring lots of fresh air. So that's one thing. But yeah, the reinstatements have been they've been proposed by some insurers already who have jumped the gun a little bit. Other insurers have looked at have withdrawn too early and realised that they can reinstate, some under pressure from brokers. It is very much a mixed picture, and everybody will get to the final position at a different pace. So what we would say is, if limits have been pulled, we would obviously look to engage to see whether you're with an insurer who's likely to be in the scheme. If so, or even if not, there are often ways that we can persuade people to reinstate limits. If limits have been reinstated that are already pulled, they may be anticipating the government scheme, or they may just have reviewed the limits based on pressure from brokers and from the market.
Yeah, a few more comments coming in. It does certainly seem to be a mixed experience out there to date, and I think very much client by client as to how they're viewing that in terms of what they're seeing from their insurers and the role of the broker as well. Before we move on to looking at some of the sectors, someone's come on saying, when you look at some of the government schemes, it seems very good PR, very good at the surface level, but when you look down at some of the restrictions being placed on businesses, it's going to mean that the practical level of support is vastly reduced. Is there a danger of that happening on the insurance, the trade credit insurance scheme?
And there's always issues specifically surrounding trade credit insurance. So we had some consultations with the guys developing the scheme within Treasury initially, and we pointed out a number of issues to them. I would say for the trade credit insurance scheme, there are two factors that you need to carefully consider. One is that we're currently in kind of a very calm phase before we see a lot of insolvencies come through. There have been a lot of deferrals. So one of the issues that we would be tackling when it comes to reinstatements is if you've got existing repayment plans or clients already past due, then theoretically they could fall outside scope of the policy. So that's a bit of a minefield for the insurers and also for the clients. So that needs careful consideration. In our consultations with insurers, they are quite tolerant on this point, provided there are sensible repayment plans in place. The other issue that might trap one or two clients is the reinstatement dates. So the insurers have different strategies for the times of the reinstatements. So some of them will reinstate back to April 1, some will reinstate back to when the limit was withdrawn, some will reinstate back to a period that is requested by the client. But these are details that need to be fully understood by both insurer and by client with the support of the broker. Hopefully, in this case, our consultations with clients are taking care of these matters. So yeah, the schemes do have one or two traps or loopholes in them, but I think the efforts to which the ABI and the insurers have gone to make sure the schemes are viable are going to make sure that it does exactly what it does, put cover back where it's needed.
Matt, also, I'd just look at two questions that are on the list there. One about a customer in the construction sector struggling to get appetite for their business because of a bad debt they've had, and somebody who has referred to limits being pulled in spite of this. I mean, we just go back to this, the same issue really, that all insurers are different, and it sounds like they may just be unfortunate to be with insurers who have reacted badly to it. There will always be some. In the last crisis, there were some who panicked and some who stayed steady. Generally, we're seeing people staying steadier, and we're also seeing appetite in the market. So that construction client, we are placing business now in the construction sector where they've had bad experience with bad debt. It's all about where to find it.
Yeah, no, that was sort of leads on to then one of the couple of other points we've got around, how can the scheme support my business? Is it relevant? Where you've got particular issues or concerns around whether it be limits being withdrawn or where you're not currently utilising credit insurance, and would it be suitable to support your business? We're very happy to have follow-up discussions in that regard as to see how we could help you in that addressing, whether it be existing challenges where you've got placements in place, or if you're looking at how credit insurance could play a role for you. So, Marshall.
Yeah. I think we have to accept that we're in this together. To get out of a crisis like this, we need strong partnerships, clients, insurers, brokers, to try and solve problems that we didn't even know existed at the start of 2020. So this kind of revolves around transparency, sharing information, understanding what insurers are looking for, being clear in terms of what your needs are. This is a new environment that we're going to have to tackle together. And if we can have proper consultation with our clients, then I think we'll get a better result. And I think that's clear from all sides, that kind of partnership is the key to us working our way through this very serious crisis.
That's a very, very good point. In terms of all in it together, working through it. Questions are coming in thick and fast. We've spoken about the construction sector, but looking more widely, are there any other particular sectors where you'll see, whether it be scheme related or more widely, sort of benefiting quicker in the context of trade credits? Where are you seeing the appetite more generally?
Well, I mean, in terms of replacing limits, Ian may be able to answer the question about appetites, but the area where the immediate action was taken were in the industries where footfall immediately affected the viability or the potential viability of a business or turnover. So, with a builders merchants group, if you close all the depots, you don't get people coming in buying goods, and the subcontractors are not working anyway, so there's no exposure. Similar on the retail side. So what we're seeing in that area is the demand for limits as people start to return to work and footfall increases, and that's where we're doing a lot of our work to make sure that the exposure or the cover that's needed matches the exposure.
Yeah, Matt, hospitality, leisure industries, where we're seeing a number of applications come back as some of the hospitality sector starts to open. So that's definitely one. I think travel, aviation's a bit behind because aviation is down, I think 95% on where it was this time last year. So that might be a bit slow to recover. I think the thing to also bear in mind is there will be some systemic cracks to the fabric of our economies that we won't see for some time yet. So fine, we will work avidly to reinstate limits that have been withdrawn from some sectors, but some of the organizations that have been subject to these withdrawals are still going to have to work very hard to get themselves back to where they were pre-COVID. That's going to, again, be a piece of work between us all to try and put that right, which is why the entirety of the government support is vital, not just the trade credit support. So lobbying for that to continue from industry groups, CBI, Federation of Small Business, the various sector groups, the insurers, the ABI, that's really vital. Everybody must be on their game consistently.
Yeah, and I think we mentioned earlier as well with the different schemes around the world, that creates opportunities but also challenges of an unlevel playing field. And similarly, where you have a focus here, but where UK government are supporting certain sectors, Ian, you mentioned aviation, within our practice in credit specialties, we touch every area. We're aware where government schemes have been unveiled supporting the aviation sectors in certain territories. Of course, that's then helped with the appetite levels as well. So that's something which needs to be factored in. It's just not government support for the insurance market, but also the other sectors and industries as well, and how that's rolled out. And invariably, that's going to create an unlevel playing field with each government putting in place different rollouts and different aid packages. Just in terms of time, trying to capture a couple of other things then. Someone's, in returns to the scheme, has asked about what's the implication for captives?
Well, at the moment, captives fall outside the scheme, unfortunately. It applies purely to the main credit insurers that we all know and love. Captives wouldn't be able to participate in the scheme, to our knowledge, at the moment. And I doubt very much if they will be going forwards.
Okay. So can I just ask Ian, Steve, just to give a couple of closing sort of roundup comments before I wrap it up, because I'm conscious we're now sort of at 45 minutes and we've addressed a lot of the questions. We're not going to get to them all, so we will certainly follow up if we haven't tackled your question. We're not hiding from it, or it's a long list, and I think if we carried on trying to get to them all, we would run out of time. So.
Well, just only from me, referring back to a final question, which relates to whether this type of cover is available to new insured customers or just existing ones. They mention that the scheme refers to reinstating cover that's been lost, and I would just say, as a general point, to look at it perhaps from the other end of the telescope and say the purpose of this scheme is so that companies continue to be able to trade with each other on open credit terms secured. It's not intended to support insurers or support specific insured clients. It's intended to support anybody trading on credit terms and to give them the confidence to do it. And so the government perspective is not whether you're insured or not, or which insurer you're with, it's whether this type of support would help you. And if it helps you, you get access to it. The fact it's backdated to 1st of April doesn't mean you need a policy from the 1st of April. It just means that where people had it, cover was backdated to then. So yeah, just a general point, I suppose. We're all sceptical about government support. The early signs of this is that it has been a positive development, and hopefully will carry on and turn into a genuine opportunity.
Yeah, I mean, it's definitely a positive development. It's part of a series of actions by the UK Treasury to support the recovery. I think as much as anything, organisations need to undertake some kind of diligence around their stakeholders and understand that suppliers, credit insurers, they are equal stakeholders. And if you're comfortable sharing information, then you're going to get a better result. And we're very happy to participate in that dialogue with those insurers with you to make sure you get the best and you optimize the levels of cover that you could get from insurers. And that's the critical piece. If you can push that to the highest level, then you're going to have more liquidity, better cash flow. And that's going to be critical as we get through this.
Thanks, Ian. Thanks, Steve. And thank you all for dialing in today. We're very grateful for your time and participation. So I say we will address those questions which we haven't got to as we go forward. We've all adapted as we've gone through this, and we went into lockdown on the 23rd of March here in the UK. In that time, we've learnt a new way of working. Every business has been impacted. Our personal lives have been impacted as well. So we've learnt some new skills as we've gone through it. But what's become very clear, even clearer as we've gone through it, the core to any relationship is communication. Picking up on Ian's point earlier, we're all in this together. We are here to help yourselves, but also to help navigate this and your businesses, support your businesses as we find our way through these uncharted territories. We do hope, though, most importantly, you're all keeping safe and well through this crisis. And I mean, we very much hope that light is at the end of the tunnel, both in terms of lockdown, but from the economic perspective as well within the UK. The trade credit market is a part of that economic rebuild, and plays a significant role in terms of liquidity as we've walked through this presentation. The situation still remains very fluid, and as we get more answers from the market, but also in terms of the EU ratification, we'll be providing more updates to you. So in terms of communication, feel free to reach out to any of us, and we'll be in regular dialogue as well to provide any further insights, whether it be via webinar or updates through emails and the like. We also have a more wider resource library as well, which you're free to help to utilise, which is our COVID-19 pandemic risk hub, where there's a lot more information there, not just about the trade credit space as well. But most importantly, I hope you all keep safe and well, get a chance to enjoy the sunshine we're all blessed with at the moment. And we thank you again for your time, and thank you, Steve and Ian, for your insights.
Thank you.
Thank you, Matt. Thank you, everybody.